Imagine waking up one morning and discovering that one of the biggest financial institutions in America simply doesn't exist anymore. No warning, no dramatic explosion, no bank doors being blown open, just billions of dollars disappearing, markets collapsing, and one of the most powerful names on Wall Street filing for bankruptcy. That was Lehman Brothers. And when Lehman collapsed on September 15th, 2008, it wasn't just the death of a company. It was the moment the world realized that the entire financial system was built on something far more fragile than anyone wanted to admit. This is the story of how Lehman Brothers went from a Wall Street giant to the largest bankruptcy in American history, and how its collapse nearly brought the global economy to its knees. The perfect storm. To understand why Lehman collapsed, we have to go back to the early 2000s. America was obsessed with one thing: real estate. House prices were rising, banks were making loans, investors were making money, and everyone believed one simple idea: house prices can only go up. Banks started giving mortgages to millions of people, even people who couldn't realistically afford them. These were called subprime mortgages. And at first, nobody seemed to care, because banks had discovered something incredibly profitable. They didn't have to keep these mortgages. They could package thousands of them together, turn them into financial products, and sell them to investors around the world. Wall Street called these products mortgage-backed securities, and they were everywhere. Pension funds bought them, investment banks bought them, insurance companies bought them, foreign banks bought them. The entire financial system was now connected to the American housing market, and Lehman Brothers wanted a bigger piece of it. Lehman goes all in. Lehman Brothers had existed for more than 150 years. It had survived wars, the Great Depression, market crashes, and countless financial crises. But during the housing boom, Lehman became increasingly aggressive. The company borrowed enormous amounts of money and used that money to invest heavily in real estate. By 2007, Lehman had become one of the largest investment banks in the world. Its balance sheet was massive, its profits were massive, and its executives believed they had found the perfect business model. But there was one problem. A huge amount of Lehman's wealth depended on something it didn't control: house prices. As long as property prices kept rising, everything looked fantastic. But then the impossible happened. House prices started falling. When the music stopped, people began defaulting on their mortgages. Banks started losing money, and suddenly those supposedly safe mortgage-backed securities weren't so safe anymore. Investors wanted to sell. There was a problem. Nobody knew what these assets were actually worth. A security that was supposedly worth $100 million yesterday might be worth $70 million today, or $30 million, or almost nothing, and Lehman was sitting on billions of dollars of these assets. The company tried to convince investors that everything was under control, but Wall Street was becoming nervous, very nervous, because Lehman wasn't just holding risky assets. It was also highly leveraged. That meant Lehman had borrowed enormous amounts of money to make its investments. And leverage works beautifully when prices rise. But when prices fall, it becomes a weapon pointed directly at you. The first warning. In March 2008, another giant Wall Street institution was already in trouble: Bear Stearns. The company was drowning in mortgage-related losses, and eventually the Federal Reserve helped facilitate its emergency sale to JP Morgan Chase. For Lehman, this should have been the warning. Instead, the company kept going. Lehman CEO Richard Fuld was determined to save the firm. The problem was, there weren't many buyers willing to take on Lehman's problems. The government wanted a private sector solution, but potential buyers looked at Lehman's balance sheet and saw something terrifying: billions in questionable real estate assets, huge liabilities, and massive uncertainty. Nobody knew how deep the hole really was. Then came the summer of 2008, and the situation got worse. The final countdown. By September, Lehman Brothers was running out of options. Its stock price was collapsing. Investors were losing confidence. Creditors were becoming nervous, and potential buyers were walking away. The U.S. government desperately wanted to avoid another Bear Stearns-style bailout, but Lehman was too large to simply disappear, or so everyone thought. Behind closed doors, executives from major banks gathered with government officials to find a solution. The goal was simple: find someone willing to buy Lehman. Two major possibilities emerged: Bank of America and Barclays. But negotiations broke down. Bank of America eventually chose to buy Merrill Lynch instead, and Barclays couldn't get the necessary approval to complete a deal. By Sunday night, September 14th, the situation was basically over. There was no rescue, no buyer, no deal, and Lehman Brothers had nowhere left to go. September 15th, 2008 Monday morning arrived, and Lehman Brothers filed for bankruptcy. Its assets were worth roughly $639 billion. Its bankruptcy became the largest in U.S. history, and Wall Street froze. Because Lehman's collapse created a terrifying question: who was next? If Lehman could fail, anyone could. banks suddenly became afraid to lend money to other banks. Why? Because nobody knew who was secretly holding toxic mortgage assets. A bank could look healthy on the outside, while being dangerously exposed on the inside. And when banks stop trusting each other, the financial system stops functioning. The domino effect. The Lehman collapse didn't stay on Wall Street. It spread everywhere. One of the biggest casualties was AIG. The insurance giant had sold enormous amounts of protection on financial assets. When the financial system started collapsing, AIG faced massive obligations. And within days, the U.S. government stepped in with an emergency rescue worth around $85 billion initially. Then came the stock market crash. The Dow Jones plunged. Credit markets froze, companies struggled to borrow money, businesses stopped investing, consumers stopped spending, and unemployment began rising. The crisis that started with American mortgages had now become a global economic crisis. Banks in Europe were affected, markets across Asia collapsed, companies around the world began cutting jobs. Millions of ordinary people who had never heard of mortgage-backed securities were suddenly paying the price. But why did Lehman really fail? The simple answer is Lehman bet too heavily on the housing market. But the deeper answer is more complicated. Lehman wasn't destroyed by one bad decision. It was destroyed by a system that rewarded excessive risk, cheap borrowing, and short-term profits. Executives had incentives to make more money. Investors wanted higher returns. Banks wanted bigger deals. And rating agencies gave many complicated financial products high ratings. Everyone made money until the music stopped. And when it did, everyone discovered the same problem. Nobody knew who was exposed. The lesson of Lehman. The most frightening part of the Lehman story isn't that a giant investment bank failed. It's that Lehman was considered too important to fail, until suddenly, it wasn't. The company had existed for more than a century. It had survived some of America's worst economic disasters, yet it disappeared in a single weekend. And that's what made September 15th, 2008 so important. It changed the psychology of Wall Street. Before Lehman, many people believed the financial system was basically stable. After Lehman, everyone understood just how fragile it really was. Governments were forced to intervene, banks were rescued, interest rates were slashed, trillions of dollars were injected into the financial system, and ordinary people paid the price through lost jobs, lost homes, lost savings, and a decade of economic uncertainty. The bigger story, but perhaps the most important lesson from Lehman, isn't about mortgages. It's about leverage. When everything is going up, leverage makes you look like a genius. You borrow $10, invest it, and turn it into $12. Amazing. But what happens when that $10 investment falls to $8? You don't just lose your money, you still owe the $10. And when an entire financial system is built around borrowed money, a small decline can become a catastrophe. That's exactly what happened to Lehman Brothers. It wasn't destroyed because it was small. It was destroyed because it was too leveraged, too exposed, and too dependent on a market that everyone assumed would keep rising. And when that assumption failed, everything came crashing down. The day Wall Street died on September 15th, 2008, Lehman Brothers died, but the consequences lived on. The crash changed banking. It changed regulation. It changed how governments responded to financial crises. It changed how ordinary people viewed Wall Street. Because Lehman's collapse proved something that the financial world had forgotten. A company doesn't have to look weak to be in danger. Sometimes the strongest looking companies are simply standing on the biggest pile of borrowed money. And when the foundation disappears, the entire building can collapse in seconds. Lehman Brothers had spent more than 150 years building its name, but it took just a few days to destroy it. And that's why September 15th, 2008 wasn't just the day Lehman Brothers went bankrupt. It was the day Wall Street discovered that it wasn't invincible.